Hey, if you're thinking about joining us in the Crypto Investors Mastermind, you probably have a few questions. Okay, almost everybody does. And so in this series, I'm going to be breaking down some of the most frequently asked questions so that you know ahead of time you have all the information that you need in order to make an informed decision. I'm going to share my screen and we are going to dig right in. All right. I would say the number one most frequently asked question, and for a good reason, what is the return on investment? Okay. And with all things investing and markets, obviously, no one can guarantee you a return. No one can say it's for sure going to be XYZ, but I think it's fine to have a reasonable expectation to say, okay, if I put my money here, probably all variables considered, what is the most likely range that I will fall within for a return on my investment? Because at the end of the day, probably you're looking for a better place to put your investment capital, right? You might be getting 8%, 10% in the stock market. You might be doing some Forex trading and you're going, I'm getting 40% APR, like I'm balling. Or you might just have some other investments in traditional asset classes and you're thinking, hey, I want to diversify into crypto. So what's the reasonable expectation for a return on investment when you utilize the strategy that we use inside the investors mastermind? Okay, so first I want to acknowledge that there are three different things to consider here, and then I'm going to break down the one that I think is the most important one to just focus on, because that's the lever that you can pull to get the greatest leverage. Number one, there is fee income, meaning you earn a portion of the trading fees generated in the liquidity pools that you are participating in. Okay. This is pretty straightforward. Like, the profit model for most centralized exchanges is they collect trading fees, and that's how they make money because they're providing a service. In this context, we're saying, hey, in DeFi, in decentralized finance, you become a liquidity provider and now you get a cut of those trading fees, meaning it's not money just made up in the sky. It's real revenue coming through that you're getting a portion of. Number two is your base asset growth, meaning, hey, if I have Bitcoin and Ethereum, to use an easy example, and I pair those together, well, those two assets will fluctuate with the market. They'll go up, they'll go down, they'll go sideways, they'll go all over the place, right? When I say base asset growth, we're talking about the long-term potential for the appreciation of those assets, meaning, hey, you could buy Bitcoin and Ethereum today, hold it for 20 years. At this point, I mean, again, no one can guarantee anything, but you'd probably make some money, right? Because you're just being patient, you're just waiting. Hey, great, buy and hold. It's not a bad strategy, but we're adding to it this other element of the trading fee income. And then the third possible source of profit is additional rewards, meaning after you earn some appreciation on those base assets, after you earn some income from the trading fees that are being generated, you could compound that and put it right back into the same ecosystem, which is also a great strategy, or you can single stake that in other environments and earn additional rewards on top of that. So yield on yield on yield kind of an approach, okay? So we've got three elements here. Now, here's the thing, base asset growth, I really can't, on a video like this, I can't say what that's going to be, right? You might have Bitcoin and maybe that goes up 2x in the next year. I don't know. Or you might have Dogecoin and it goes up 20x or whatever. So the base asset growth is just, it's going to happen on its own. So that one, I just go, hey, you know what? Most likely, again, assuming you pick the right blue chip assets that are legitimate crypto projects, over the long term, more than likely those are going to go up and to the right, at least to some degree. Great. But what I can have a little more control and awareness over is this piece right here. And there's two considerations when we talk about income from the trading fees. The one is our target range. Okay, this is what I'm aiming for, which influences the decisions that I make for which pools that I enter. And then we have actual. Okay, the actual might be a little above the target, might be a little bit below, but over time they kind of average out to what that target range is. So for example, if I pick a target range, some ludicrous target range, like I want to earn 800% APR on all my pools all the time. Well, guess what? The pools that you enter are not going to be really reliable places to put your investment capital. You're probably going to be dealing with some base assets that could easily tank to zero. Okay. But when we set the reasonable range, and this is what I recommend to everybody, is 50 to 100% per year APR on average. Okay. So if I set my target range in that reasonable range, which, yes, that is reasonable for crypto, then the decisions that I make are based on that target range. So now I say, hey, I can pair up Bitcoin and ETH. And if I get, 50% or even 40%, maybe I'm falling a little bit below that, I'm okay with that because that was my target range. So I set it to 50 to 100, and maybe I do a blue chip pair and I land at 45% for that one. I go, you know what? That's actually not so bad. Then maybe I pick a different pair and I go, oh, well, that pair got me 98%. Now, between those two, obviously my portfolio would be more than just the two pairs, but between those two, now collectively, I'm landing within that more than reasonable target range. Okay. So consider that just the trading fees that you earn. That's what I'm talking about here. So when you say ROI, total ROI, you're probably going to be able to add to that long term with the appreciation of those base assets. Again, assuming that you're picking the right assets, right? But just the trading fees that you can earn from the model that we're leveraging inside of the mastermind, 50 to 100% APR is actually a reasonable target range. So remember, the purpose of target range is to inform the choices that we make for which assets that we choose to actually farm. And then the actual, oops, I lost my screen. I was about to switch over anyway. And then the actual is, of course, what you actually get. Now, what I wanted to do to finish off this video is show you an actual range. Let me pull this up here, and then I'll share my screen again, and we can take a look. Now, what you're going to be seeing here is my demo wallet. Okay, so for my demo wallet, I just open up positions and I kind of explore around. I use it as a way to inform everybody in the mastermind, like, hey, what's performing really well right now? What's maybe not performing as well? And a while back, I opened up a position with ETH and Link on the Arbitrum network. Okay, if ever there were two blue chip crypto assets, ETH and Ink, right? ETH and Link. You might think, oh, there's, you can't earn much with two assets like that. Now, and this is just my opinion, obviously, but I think that long term, ETH and Link are going up and to the right. Like, they're legitimate projects. They add value to the infrastructure of the crypto ecosystem, and they are poised long term for eventually for mass adoption. So what that means is I'm confident in these two assets, so I don't mind holding them. And again, I could buy them, hold them, wouldn't be a big deal. It would be great. I'd make money. But along the way, I'm choosing to earn additional APR by pairing these together and becoming a liquidity provider. Now, what you're seeing here, unclaimed fees, that's from a little less than 24 hours, meaning I forget what that comes out to, like 0.4% or something like that on the day, just on the daily APR. But I can use a tool like Revert Finance here and just say, hey, what's my actual APR? Just on the fees. Because the value of those base assets, it's going to go up, it's going to go down, it's going to go, especially in the short term. Like crypto, even like blue chip crypto assets, they can tank 30, 40, 50% in the short term. They recover, they come back, and all over the map, right? The point is, with the trading fee income, whether the chart's going up, down, sideways in the short term, you're still earning, you're still accumulating additional assets. Right now, this one is performing at 149% APR. That might sound crazy, right? But that's just where it's at right now. And I go, you know what? I'm above my target range, so I'm good. Like, I didn't try to get that 149. I was just aiming for 50 to 100%. But because I'm in that target range or above that target range, I'm okay, because now I can know that, hey, if I have another pool that falls a little bit below 50%, I'm still okay because I'm still hitting that range. So I hope all that makes sense. When you ask about what's the intended ROI, you have to be aware of target range and actual range and what you want to put your attention on. Because yes, there's base asset accumulation over time, base asset growth over time, but what you want to focus your attention on is what can I earn from those trading fees expressed as an APR, because that's the gravy on the top. And I'm talking if 50 to 100% is like the extra, the gravy on the top, you're doing great, okay? And you can just rest in that, knowing that, hey, I don't have to play this crazy gambling crypto game, which a lot of people are playing. I can stay in what I believe to be the reliable side of crypto, meaning by crypto standards, these assets are the ones that are most likely to perform long term, and you can still earn amazing return based on that. Okay, stick around, keep watching this space. I'm going to be posting more videos for FAQ, all the frequently asked questions that investors like yourself want to know so that they can make an informed decision about whether or not the mastermind is for you. Catch you next time.